Welcome to TheoTRADE. This is Don Kaufman. April 26th, 2024. 15 minutes to go. It's the cash close here on this Friday afternoon. Markets ripping to the upside, up some 51 handles. But before we get into anything, I'm just going to outright state I don't trust this rally a bit. You shouldn't either. All right, with that, let's get right into it here on this weekend's update. So, as I was saying moments ago, the S&Ps are up some 53 handles, and overall, it's a nice bounce back to the marketplace. But, hey, a statement a moment ago, I don't trust the rally. I'm actually going to get into quite some depth. Why, first of all, I don't trust it, and you shouldn't either. And it's not about, a MACD or a Fibonacci or a Bollinger Band. There are risk assets in play that simply are not right for this kind of a rip and bounce. It's not to say that things couldn't change next week. I mean, one of the things we're going to talk about is right now, we're in a catalyst-driven marketplace. And that simply means it's what I often term, we're just chucking chocolate-covered hand grenades into this marketplace. Every single economic announcement that comes out, we got to deal with the Fed. Let's throw a little earnings in there. It's wild. And every one of those catalysts is this binary event. But again, there are risk assets that are just simply not right for the kind of rally that we've seen. Let's start with just looking at overall markets, some of the price action in it throughout the course of the week. So the S&Ps, if they were to close right now, right here, we are outside the upper edge of the expected move. Let's get really specific. This week of trade, first of all, was fairly wild. I mean, say what you will about it. We rallied, except on Thursday. I mean, the S&Ps were down 70 handles at one point, took back off to the upside, almost got back to massively unchanged, had earnings after the bell. We exploded to the upside. Now, where are we? I mean, what, 120 points from the start of the week? Look, we started the week right around 49.68. We'll round it. And here we are. I mean, beyond that, what's 120, 130 points amongst friends? So an explosive week to the upside. All right, what was the driver behind it? Unequivocally tech. Let's go look at the QQQ, because in the QQQ, we're going to bring up auto expected moves. In terms of the auto expected moves, it tells you in detail, like, look, NASDAQ exploded. I mean, almost to the tune of 2 deviations to the upside. But, okay, you do have to recognize it has been the NASDAQ that took the biggest hit specifically last week. So the NASDAQ has a rip and bounce. Now, I probably don't have to tell most people this, but the hallmark, okay, of volatility, okay, yeah, you can measure it by, the violence of some of the down moves, but it's the explosive nature, often of the up move, that I look at to be kind of the hallmark, again, of a more volatile situation. And this was an absolute ripping week. Now, the other aspect that I look at and kind of call into question here, okay, has a tremendous amount to do with the fact that, well, we smashed through the lower expected move last week, which is, the way to think about an expected move. Like, look, last week we were supposed to move like $100. We moved more than $100. Then this week, you're supposed to move $96. And this week, obviously we smashed through again. The day is not done. There's only 10 minutes left. But so we smashed through again. And there's just a way to view this is it's a little bit of like unruly trade. Trade is like, it's not as efficient, if you will, okay, as you might think. It might be efficient on a day-to-day basis, but when you're starting to smash through expected moves, it's like the market is being ripped apart at the seams. And you're like, well, why do you look at the SPX to assume that? Because nothing has anywhere near the notional value. That's basically what I'm saying is, okay, how much money is actually traded through this product? Well, you're doing what? Almost 2.7 million contracts of a $5,100 product. And then if you look at the spiders, okay, you take a look at the spiders, and the spiders are doing about another 7 million contracts. So, that's 10 million contracts right there between the SPX and the spiders. That's not even including VIX, right? So you got a cool 10 million contracts trading. The entire marketplace might do 50 million contracts today, but the SPX contracts, the SPX contracts are 20 to 30 times the size of most stocks in terms of like magnitude, right? In terms, of course, of notional value. Notional value, again, if you put in like the equivalent of how much capital are you trading through here, the answer is an absolute proverbial crap load inside of the SPX. That's why it matters more than any product. And you start to look at it and you're like, holy crap, an interesting point, because the market becomes totally unruly if that much capital is wrong. The way I think of expected move is, look, the market's got it wrong last week. They got it wrong again this week. They're kind of getting ripped apart at the seams. It's something to pay attention to. Again, some of the hallmarks of bigger volatility. But that isn't like, I'm really not looking at a chart and saying like, well, technically this was the down move and this is the up move and we could go down from here. That's actually not what I'm looking at. And as I said, always poking fun at MACDs and Fibonacci's and so forth. Look, okay, I don't have any skin in the game looking at the chart and trying to decipher what's going on. What I do look at, though, as I said, there's other risk assets. One of the things that bothers me this week, I'll start with VIX. I'm not a big proponent of VIX, but if you look at a rip and rally today, today alone speaks volumes. Huge rally, right? 1%. But that's after, of course, we rallied back from being down 70 handles yesterday. But, huge rally in the last like 24 hours of trade. The VIX is barely down. You could look at the marketplace today and say, like, if the VIX was down 5 or 8%, you wouldn't even bat an eye. Doesn't it look weird, though, that VIX barely moved and you're coming into a Friday, right? It's not like a big holiday weekend or anything, but you're coming into a Friday. So what's going on? Why isn't vol crushing? Moreover, if you look at the volatility futures, they've definitely come off. Okay, the volatility is abating to some degree. I'm not disputing that. What I have issue with is when you start looking at the volatility, okay, futures, and I'm going to freeze the screen for a second, kind of highlight, there's May, okay, and here's June. So what we're looking at is 26-day May volatility futures versus 53-day June volatility futures. And we haven't really like backed off all that much. The differential between the May and the June is only about 45 cents. In effect, what I'm saying is volatility futures right now are screaming to you, don't put down the weapons just yet. Don't put down your volatility weapons just yet. We're still in the midst of what is a relatively serious marketplace. To look at it any other way, just from a volatility standpoint, I think you would be, diluting yourself to a degree. So again, you can look at, and some people point out, well, take a look at the VVIX. That's the volatility. Okay, the volatility index. The VVIX should be crushed because the way the VVIX works, the VVIX is the volatility index. That is for a lot of people like professional side of trade that trades the VIX. They go out and they reduce risk, okay, at the first sign of smoke. Well, we saw the first sign of smoke. We saw fire. The VVIX already spiked and now it abated. The point being is, okay, we already saw a little bit of shock and awe in the marketplace. Don't expect VVIX to explode higher unless markets got really, really serious at this point. So the VVIX is not categorically a great indication of risk moving forward here. What really bothered me too is like this 3-month volatility. It's come down. It just doesn't look right now. Now, whatever. I guess volatility is only one indication. Well, the next indication, the bond market. Okay, bonds are still absolutely on the edge. Bonds are a couple of ticks off the recent lows, and maybe a better way to look at bonds, because bonds really kind of freak everybody out. But I think the better way lately to explain this is to look at the TNX. By the way, the TNX changed symbol. It's TNX, okay, CGI. So TNX, colon CGI. I know it was dispute or whatever going on in there, but anyway, they changed the symbol. But I wanted to show you in terms of the 10-year. Okay, interest rates are basically at highs. Okay, is that going to be good for markets? Well, look, it's only going to take a little bit of a push higher and we're right back into heavy volatility. So it's that easy to explain. Number one, the volatility itself looks off. Number two, the bond market is not recovering. If the bond market recovered and volatility collapsed, okay, I might feel a little bit better about this thing, but I don't, not yet. The next thing you have to deal with is, of course, today. Today we had PCE data. Now, PCE data today, and it's neither here nor there. It doesn't matter what it is. Like I'm a big, if you will, price purist. I don't care what the data is, but you will know that the PCE data, which is inflationary data, and it's the Fed calls it their indicator of choice relating to its personal income, expenditures. Anyway, the Fed says it's their preferred indicator of choice. And that basically implies like, okay, they look at it. It was hot. It was a very hot number. You would have assumed today that the marketplace, when the PCE data came out, you would have assumed the market's going to crash. It rallied and then faded. It had no real impact because Google and Microsoft apparently are more important now than inflationary data. I'm all right with that. Brush it off, okay? Because the way I look at PCE data is like every other data. Chocolate covered hand grenade. They just keep chucking them in the market. It's a catalyst. And you'll see catalysts for the week. I don't even call it like economic data anymore. Who cares? Okay? Chocolate covered hand grenades being thrown at me at high speed. Dogs and cats living together. Anyway, you got PCE, okay, pointing towards it's inflation that's reigniting. And now you have the Fed coming out. The only thing I would say about the Fed this week, and listen, I'm not going to preach about, the Fed, they're not going to raise rates. They're not going to lower rates. Like they're just going to leave rates alone. But one of the things that I have constantly argued, and I do want to put an opinion over here, you cannot kill inflation until you slay the asset dragon. That is, people feel like they have a lot of money when markets are sitting just stone's throw off all-time highs. Now, it's not the Fed's mandate to knock markets down, but it sure as hell would help them if the market did sell off. Why? Kills inflation overnight. You want to kill inflation? Kill the market. And that's one aspect. People may disagree with it, but I'm going to tell you right now, you're not going to be so apt to want to go out there and run out and spend. I'm buying a new car. You're not buying the new Mercedes if the S&Ps are trading 20% less than they presently are. Think about it for a second. If you want to slay the dragon, you got to kill asset prices. And asset prices right now, I apologize. They're inflated. And I apologize for it because I don't see a way that you kill inflation without killing the market to some degree. That is a big opinion piece, of course, in this weekend's update. Next in the docket, all right, you have other asset issues over here. Oil's still sitting a stone's throw off its all-time high. That doesn't make me feel warm and fuzzy. Enough said on that front. Okay, oil, there's still geopolitical risk, even though you felt it abated to some degree. Clearly, the oil market may not agree with you, but I don't think oil is necessarily in scope. What's definitely in scope for me, though, would have to be gold. Gold got crushed. Yeah, right up until the point it started rallying again. So gold is still pointing to, inflationary pressures. Gold had a magnificent breakout. I mean, where do you want to put it? At the 2000 level, the 2050 level, or right here at the 2150? I mean, how many times does it have to break out for people to start to pay attention? Got some debt issues in the marketplace. But again, if this rally is to hold, I don't like where gold is for right now. So, now I'm looking at lack of volatility crush, right? The volatility futures look a little weird to me. Then the next thing, of course, is bonds. I mean, come on, bonds sell off a little bit. That's not going to be good for the markets. Then we actually come into, oil, gold, and of course the dollar, right? Gold is still very near highs, and the dollar, if I didn't know better, but I would say the dollar is actually about to break out to the upside. That is going to export inflation. Again, not a good sign for economic times there in a dollar that is that strong. So a lot of factors here. And again, all I wanted to do on this weekend's update is point out factors that people might not necessarily look at. You can look at price action till you're blue in the face. You can look at the financials, and what are the financials done? Oh, well, they rallied this week, but not as much as it's not going to help you. Okay. All I'm trying to point out is the marketplace right now, evidently sees risk ahead. It doesn't necessarily mean that we tank, okay? But if you trust this rally, I think you're going to be in trouble. I think you're going to get some wicked two-sided trade because there's just too many catalysts to add, okay, to the complexity, if you will, of catalysts out there. And again, there are a lot of them. That's going to be the closing bell of the trading session today. Anyway, to add to some of the catalysts out there, this is the Japanese yen, and it is a disaster. Okay, if there's a crisis actually coming, you're going to hear a tremendous amount about this. Now, I don't have time to go into too much depth about Japan and the yen, but the influence here in the U.S. could be phenomenally large. Taking a look at this, for those of you who are looking right now, you're looking at a 9-month. Okay, it's /6J. Take a look at a 5-year on here. I mean, this is an all-out crash. They're losing, okay, the Japanese yen at this point. There's no question that the Bank of Japan is going to have to come in and going to support this. The influence of that support, though, that can be felt in a lot of different ways over there. And of course, if you're in like Bitcoin and so forth, people are going to be like, it's going to be good. Possibly horrific, but it could also be really bad for some of the asset prices out there. Again, I think we're going to feel a lot of impact for the yen, which is in crisis. And if anything, just to spark what could be a very serious, not just yen in crisis, but debt crisis throughout the course of the world. Again, currencies are going to be called into question all over the world if you're losing something like the yen. I mean, it's that wild. All right, one of the last things I want to mention here before going into the SPX expected move is just catalysts for the week. And there are many of them. All right, I look at the calendar, okay, and I'm just going to tell you right now, know what's on the calendar. Set, like if you're on Thinkorswim, you can actually create alarms for stuff. Know what's on the economic calendar. Get comfortable with it each day. Okay, while live on TheoTRADE, I'm going to mention everything that's coming and what's coming the day after. Monday, we start the week soft, except on Monday. What is not on this calendar is Janet Yellen and the Treasury refunding. Late in the day, the Treasury will actually show, okay, how they're going to do the refunding. That's basically a just gargantuan amount of debt that's going to be rolling over. Implications could be huge for the market. Okay, I argue that a lot of the implications, the positive ones, have already been priced in, possibly why we're rallying right now. Think about that for a second, because a lot of people are bullish because the last time the Treasury did the refunding, it goes back a couple of months ago, the market exploded to the upside. I think some of the explosion to the upside was the rally this week. Could also be one of the reasons volatility refuses to back off. As the week actually progresses, well, game on! Okay, you've got a lot coming. Obviously, the Fed announcement, okay, coming into Wednesday. There's also jolts, there's construction spending, there's PMIs. I mean, it is chock full of nuts, okay, when it comes to the calendar this next week. You start to look at like factory orders. It just doesn't stop throughout the course of the week. And of course, to cap the week, you've got a situation. It's the employment situation. So, it's just, as I said earlier, it's not about the employment situation. Who cares what the jobs number is going to be? Nobody trusts the jobs number anyway. Okay. If you do, you're the last one that actually trusts that number. But I mean, nobody trusts the Fed anymore either, obviously, but it doesn't make a difference. And yes, I'm poking fun at that, being a little facetious on that front. All you have to look at is catalyst after catalyst after catalyst, and be aware. Okay. The individual catalyst in day-to-day trade is going to be wild. If you think you're going to be able to handicap what one day looks like versus the next, okay, forget it. Like, those catalysts are going to move that marketplace. They're going to change the feel of trade. You just got to look at things like risk assets, like bonds don't look right. Volatility doesn't look right. It'll give you a better feel. I'm going to try to give you a better feel throughout the course of the week as well. Again, that's the kind of trade, though, that we're going to be in right now. People, I was born in volatility. I love volatility, but day to day, okay, make no assumptions in volatility. All you can do, put on some defined risk positions, sit back and let the market roll. All right, last thing we do each and every weekend here at TheoTRADE, we take a look at the SPX, the mother of all products. So what you're looking at right on your screen here, trend line right here, okay? That line actually represents the upper edge of the expected move. We were shooting for basically 50.63, okay? Tried for the corner and missed. Huge breach of the tune, okay, of what? for almost 40 handles outside of that. So this is a very significant breach. Again, a very significant breach of expected move. As I said, it's markets, my interpretation, it's markets getting a little bit unruly. So we just passed through a week that had a $96 expected move. What is the expected move for the coming week? Open up, okay? We're not officially closed yet on the SPX, but we're coming into another week. This one even worries me a little bit more. The expected move is about $84. Why does that worry me? So what we're anticipating for a week that I just said is just loaded with chocolate covered hand grenades, we're looking somewhere right around an $84 move. What concerns me about that is you've got from what, where we started last week to where we're presently, 130, 140 handles of movement. And then you're telling me they're only going to move 80 some odd dollars, okay? In the expected move over there, it looks extraordinarily light. I'm going to tell you again, keep your hands and feet inside of the vehicle this next week of trade because I just don't trust this rally a bit. You shouldn't either. Thanks everybody for joining us here at TheoTRADE. Have a wonderful weekend. Bye-bye.